MACD is one of the most popular technical indicators used in trading. It is a simple yet effective indicator that is versatile. You can use it to trade with the trend and identify trend reversals. Not many indicators can do that. So in today's video, I will reveal the secrets of using the MACD successfully, which works for both Forex and stock trading. I will show you how to incorporate this into your trading strategies seamlessly, so make sure to watch it till the end. MACD is the short form for Moving Average, Convergence, Divergence, and from its name, it's obvious that it consists of moving averages in its calculation. The MACD turns two trend-following moving averages into a momentum oscillator by subtracting the longer moving average from the shorter one. And while it is relatively easy to use, I want to make sure you understand how it works instead of blindly using it. Before we take a closer look at the structure of the MACD, we are currently doing a giveaway for our premium Forex signals. So what you have to do is look for an emoji in this video, and once you find that emoji, comment below the emoji plus Forex signals. And you can potentially win lifetime access to our premium Forex signals. We will announce the lucky winner in the next video, either in the video itself or the comments section as a pinned message. So make sure you subscribe and hit the notification bell to know when the next video comes out and whether you have won. The MACD indicator has three components, two lines and a histogram. The MACD line is the faster line on the indicator. It reacts faster to price changes and is more sensitive. The second line that you see here is the MACD signal line. It is slower and less responsive. Then we have the MACD histogram, which represents the difference between the MACD line and the signal line. The bigger the gap between the two lines, the higher the MACD histogram bar will be. When the two moving averages are coming together, they are said to be converging. If they are moving away from each other, they are said to be diverging. So, the MACD is essentially a trend-following momentum indicator that shows the relationship between the two moving averages. If you want to know how to use the MACD effectively, then make sure to keep watching. Let me explain how the MACD line works. It is calculated by taking the difference between a longer period and shorter period exponential moving average. The exponential moving average is used because they respond more quickly to price changes as more weight is applied to the recent price. I've previously done a video on moving averages, and if you want to learn more about that, I will link to this video on the top right. You can use any length of period for the exponential moving averages, although the default setting is the 12, 26, and 9 period exponential moving averages. This chart shows the relationship between the two moving averages and the MACD for Euro-Dollar. The top portion of the chart shows the Euro-Dollar price over time, along with the 12 and 26 exponential moving average applied to the chart. Over at the bottom, we have the MACD line, the signal line, and the zero line. A couple of observations to help you understand how the MACD works. The first observation is that as the two moving averages diverge, the MACD line rises or falls. Secondly, whenever there is a moving average crossover, you will also see a corresponding crossover, the zero line, by the MACD line. Thirdly, when a signal line and MACD line crosses over, you will see a corresponding crossing of the zero level by the MACD histogram. Through these observations, you should understand that the interaction between the two lines and their positions relative to the zero line is important when using the MACD indicator. When the MACD line is above the zero line, the shorter period moving average is above the longer period moving average. This indicates that the market is bullish, very much similar to a typical moving average crossover. You will also see that the MACD histogram is positive and is plotted above the zero line. The converse is also true. When the MACD line is below the zero line, the shorter moving average is below the longer moving average. This indicates that the market is bearish. You will also see that the MACD histogram is negative and is plotted below the zero line. Now that you have a thorough understanding of how the MACD indicator works, let's get into the 3 ways you can use the MACD indicator, which are crossovers, overboughts, oversold, and divergence. Crossovers are one of the most basic ways to use the MACD indicator. A buy signal is generated when the MACD crosses above the signal line, and when the MACD crosses below the signal line, then a sell signal is generated. If you want higher probability crossover signals, then you want to pay attention to where the crossover signals happen, above or below the zero line. Bullish crossover signals are more reliable when it occurs below the zero line. And of course, bearish crossover signals are more reliable when it occurs above the zero line. When both lines crosses the zero line, that is a good confirmation. Here are some examples of MACD crossovers to illustrate this. It is important to note that crossovers are lagging in nature and thus work best in a strong market trend. In a market where the price is going nowhere, the MACD results in many false signals. It is intended to keep you on the right side of the market. I will show you how you can better use this powerful indicator shortly, so make sure to keep watching. The second way to use the MACD is to use it as an overbought or oversold indicator. An overbought condition means that the instrument has experienced a significant upward move, and an oversold condition is one where the instrument has experienced a significant downward move. After a significant move, you expect the price to revert to the mean as profit taking happens. So let's talk about what happens during an overbought condition. Essentially, what is happening is that the faster moving average used is rising faster than the slower moving average. This is an indication that the price is overextended and may reverse at some point in time. The opposite is true when we are talking about an oversold condition. Earlier on, I talked about how the bear buy signals occur below the zero line and the bear sell signals occur above the zero line. But I didn't give you the reason. Now that you understand overbought and oversold, it should make sense why this is so, because price is likely to reverse after being overextended. One thing to note about the MACD indicator is that there is no fixed level to determine overbought or oversold conditions. Unlike the other technical indicators like the relative strength index or stochastic indicator with fixed levels to reference, the MACD doesn't have any fixed levels. The highs and lows of the MACDs are relative, so spend some time looking through the historical highs and lows of the indicator for the instrument you want to trade. The last way to use the MACD is to identify divergence. This is my favorite way to use the indicator, so don't miss this and keep watching. Recall how I introduced the MACD as a versatile indicator that can identify trend change at the start of this video? Well, a divergence occurs when the MACD indicator trends one direction while the price goes another. It hints at a reversal in the current price trend. Let's have a look at a bullish divergence. A bullish divergence forms when the price records a lower low, but the MACD forms a higher low. Essentially, the lower low formed by price affirms the downtrend, but the higher low in the MACD indicator shows sign of momentum slowing down. You can see that the MACD is making higher low even though the price is still declining. You can use the MACD line, the signal line, and the MACD histogram to search for divergence. The highest probability signals occur when there is a double divergence, when the lines and the histogram both show a divergence. Here are some examples of double divergence to help you better understand this. Using the divergence can help you predict market turning points and provide you with an edge in the market when applied correctly. You want to combine this with trend analysis, price action, and market structure. Before I end this video, I want to address what time frame you should be applying this on. Well, there is no best time frame to use the MACD indicator, and you should select a time frame that best suits your lifestyle. However, I want to point out that the higher the time frame, the more significant the signal is. It is common to have conflicting signals across different time frames. Different time frames can have their own trends, and different time frames may show you a different MACD signal. The rule of thumb in such cases is to lean towards the higher time frame. For example, if you have a bearish signal in the daily time frame and a bullish signal in the H1, you want to lean towards the daily time frame. To sum up this video, the MACD indicator is a versatile indicator that can be used for trend following and to identify reversals. It consists of the MACD line, the signal line, and the histogram. You can use it in three ways: the crossover, overbought, oversold, and divergence. I hope you learned something useful from this video. Please leave a comment below and let me know what your biggest takeaway was. Leave this video a like to show your support, subscribe to this channel, and hit the notification bell so I can help you become a better trader. I have also prepared a 3-day trading guide which you can download via the link in the description below. Thanks for watching. I will see you in the next video.